So, colleagues, today is Thursday, almost the end of the trading week, and let's look at the market from the perspective of wave analysis. Let's start with the first instrument, which is gold. For trading gold, it's best to first analyze the higher time frame charts to identify trends, and then shift to a lower time frame for more precise entries. On the higher time frame, specifically the daily time frame, we must consistently understand the broader market structure by utilizing wave analysis techniques effectively. Waves assist us in comprehending our current position in the market, whether we are at the beginning of a new trend, in the midst of one, at its conclusion, experiencing a correction, or undergoing an impulse. In essence, waves carry a wealth of information, yet not everyone fully comprehends the reasons behind why they construct these waves in the first place. So let's take a moment to carefully assess the current situation. We observe a clear upward trend structured within the framework of 1, 2, 3, 4, and 5, where the fifth wave represents a strong impulse. After the completion of the fifth wave, we can expect to see a correction in the form of an ABC pattern, moving in the opposite direction. ABC has successfully completed its movement, and now the market transitions into a new structural phase. The first wave is identified as an impulse wave. This entire sequence could potentially be categorized as an ABCD pattern, and quite possibly this entire formation represents a triangle pattern in the second wave of correction. Triangles typically manifest in the market as corrective movements, phases of accumulation, periods of consolidation, and eventually lead to the next significant impulse that breaks out from within the triangle's boundaries. For instance, at this very moment, this particular structure strongly reminds me of a wave model that I have encountered before. Of course, it's important to note that everything is not perfect with the latest waves D and E, as some issues remain. In principle, it generally looks like this. The sequence represented is ABCDE. Open the comprehensive Elliott wave book and you will find detailed examples of various triangle models, where you should observe a gradual decrease in the highs and a corresponding increase in the lows, illustrating the market's shifting dynamics. So look, wave A is consistently positioned below wave C, while wave B is always found above wave D. Additionally, D is located beneath wave B, and E is situated below wave C. You understand the relationship, right? There's a distinct narrowing pattern within the ABCD structure, so I assume that for gold this could have been wave E, but I can also suggest that wave E might still reach this lower boundary. Typically, a triangle pattern consolidates between the upper and lower trendline boundaries. Therefore, we will likely either witness a reversal at this point, or alternatively, gold might break out beyond these levels, triggering stop losses for those holding positions. This situation requires careful monitoring, as the market dynamics can shift rapidly based on new information or changes in investor sentiment. Well, we currently have a buy open, and we will complete this wave V at this triangle boundary, and then possibly a new impulse will start. That's why all the essential prerequisites for purchasing gold are still firmly in place and continue to hold true. Here's a detailed view on the 4-hour trading time frame. On the 4-hour time frame, take a moment to observe that gold is currently forming its initial impulse wave in this upward movement. Following that, we can identify an ABC correction wave, which signifies a brief pullback. Additionally, we are witnessing this narrowing structure developing, which is characterized by converging channels. When you encounter this wedge-like figure, it typically indicates a potential reversal in the market trend, suggesting that a significant change in direction may be imminent in gold prices. If this key figure breaks down, the price will likely continue moving in the direction of the breakout trend. Currently, regarding gold, I provided a buy entry point yesterday at this specific level, indicating where to purchase gold, with a stop loss placed just below the established double bottom. Indeed, it was an aggressive trading strategy, and here is how to set a potential profit target. More conservative traders might have chosen to enter the market here upon the breakout of this specific channel. That's why I currently have a buy open. I also provided you with this trading recommendation at the beginning of the week, indicating that gold would likely bounce off the 382 level. However, as you can clearly see from the market movements, it didn't occur as quickly as I had initially suggested it might. I believe I shared this trading idea with you around Monday or Tuesday, shortly after the market proceeded to adjust the minimum, resulting in a downward movement. Perhaps someone was stopped out or someone is still holding their position, but overall the direction towards 3 is still relevant. That's why I believe this upward movement in gold is currently establishing the first subwave of a larger trend. Conversely, the downward movement appears to be a retest of the channel, and it may also represent a potential second subwave. Now let's transition to observing the details on the hourly time frame to gain further insights into these movements. On the hourly time frame, it is well known among traders that you can effectively trade smaller waves on a lower time frame while maintaining a position aligned with the direction of the higher time frame trend. How to trade correctly. Look, when you observe that on the 4-hour time frame, for example, your second wave is completing here, it makes perfect sense to look for the first and second waves starting from this point. Many traders consistently ask me the same question. Ildar, how exactly do I identify the first and second waves in the market? Understanding this process can significantly enhance your trading strategy and improve your ability to make informed decisions based on wave patterns. In fact, this is a crucial question to consider because many beginners, when they focus solely on one single time frame and only draw one or two indicators, often make significant mistakes. This happens because they fail to analyze the higher time frame for better context. On the higher time frame, I observe the formation of the first and second waves for gold. I assume that the second wave might come to an end here, so we need to carefully look for both the first and second waves on the hourly time frame for better analysis. Let's transition to the hourly time frame now. What observations do we notice here? We observe a clear upward movement. We all know that the initial impulse's first wave is always composed of 5 distinct subwaves, so this specific movement will represent the first wave on the hourly time frame chart. The initial wave consistently follows a sequence of 1, 2, 3, 4, 5, indicating that there are a total of 5 distinct subwaves present within this first wave. Next comes the second corrective wave, identified as ABC. This second corrective wave must also have a Fibonacci retracement drawn to accurately measure the level of correction, ideally reaching at least the 61.8% level. I utilize the Fibonacci tool and observe that the first significant zone aligns at 61.8%, indicating the extent of the correction effectively. That's why I assume this is the second corrective wave in the overall market trend. Also, this first and second wave on H1 will serve as the first and second subwaves on H4. You need to understand this logic. The higher time frame represents subwaves while the lower time frame shows the global waves. If you trade on the lower time frame in the direction of these subwaves on the higher time frame, you will always trade with the trend. It's no coincidence that they say in the market the trend is your friend, and this is how the higher and lower time frames are verified. If we closely examine the current hourly time frame now, we can clearly see that a complete first wave and a complete second wave have successfully formed. Next, I typically proceed to draw channels in this manner. The breakout of the price channel typically indicates the next key entry point for the anticipated third wave. That is around 33.80. A stop is typically placed here for the purchase, as well as where the take profit is established. This is a standard entry point that I consistently provide during my training sessions, which I teach to everyone, and together we diligently work on improving your specific markings. This is the entry point. You can also enter on the breakout of the first wave's maximum. I think many wave traders have been trading this way with a stop behind the second wave. The take profit is set here, either at 261.8 and you take 345, or at the third wave you take your money. At this moment, it appears that gold is in the process of forming the initial stages of both the first and second waves. Following these, we can anticipate the emergence of a third wave, succeeded by a fourth and ultimately a fifth wave. This entire sequence is unfolding on the 4-hour time frame. Notably, the wave structure we are observing will culminate in the fifth subwave within the larger third wave that many of us are eagerly anticipating. So regarding gold, guys, the question was whether it can be bought now. Essentially, if you were actively trading in our exclusive closed community, you would have purchased gold right at this point yesterday. However, it is indeed possible to purchase gold during market corrections, but if you decide to buy gold at this moment, make sure to set a stop loss at least behind the initial point of the price impulse, as it remains uncertain whether this current correction will conclude at this stage. The correction could potentially go lower, possibly by this evening or tomorrow, and may subsequently rise again afterward. So this is truly an unpredictable part of the market, specifically the correction phase. I don't always predict with precision exactly at which Fibonacci level the price will end, but I do have a solid general understanding of this specific zone, and I recognize that it all constitutes a significant market correction. After this correction ends, I usually can tell when the channel correction will finish. Channel breakouts signal new impulses in my drawing analysis. A drop below the channel indicates a correction. It's straightforward. I cover this in my training. That's precisely why we continue to hold on to our gold purchases. Most likely the first and second waves are forming now, and we will wait for the next impulse of 3, 4, 5. It may not happen by the end of this week, but possibly by next week. However, the overall breakout of the channel indicates that gold prices could rise significantly, so we will continue to hold on to our current purchases for now. Always manage your risks. When discussing the risks associated with my trades, I would like to illustrate an example. My designated risk per trade on gold is $712, which indicates that I am prepared to lose up to $712 on this specific trade, representing 1% of my total capital. I strictly follow risk management. I never enter the market with my entire deposit. I see many eager traders who saw one of my trades, went all in, and when it didn't go as planned, they hit their stop loss and ended up losing their deposit. Then they ask me, "Elder, why aren't your signals working?" That's why I feel it is crucial to advise all these beginners that until you consistently adhere to sound risk management practices and avoid putting your entire deposit into a single trade, you will likely struggle to make any profit in this challenging environment. To earn consistently over 6 months to a year, you need to manage your capital. It's a comprehensive science that requires careful study, and you should dedicate time to thoroughly learn it. So here my calculated risk per trade is $712, while the potential profit amounts to $8,000. So you see the trade ratio is essentially 1 to 9, meaning roughly 1 profitable trade for every 9 trades made, which presents quite promising opportunities for success in the long-term perspective of investing and trading strategies. If you execute, for example, 10 such trades and only 2 turn out to be profitable while the remaining 8 do not yield profits, you will still end up making money overall. There is also an entire field of study dedicated to capital management, where it is essential to consistently monitor and analyze your trading statistics from the moment you begin trading to ensure informed decision-making. To effectively track your trading performance, meticulously record the number of trades executed each month, categorizing them into profitable and unprofitable trades. Additionally, over a span of 3 months, calculate your overall percentage of winning trades as well as your percentage of losing trades. Don't forget to monitor your stop loss and take profit levels. Analyzing this data will contribute to a more informed, strategic, and intelligent approach to your trading endeavors. The more statistics and data you have on yourself, the more you can rely on them to foster personal growth and improvement. Expand your knowledge and recognize what you might be doing incorrectly. Reflect on whether your current work strategy is truly effective and consider what factors have changed recently. Overall, all of this is based on statistics. If you find yourself consistently overestimating risks in trading, consider examining traders who have been actively trading for 1 or 2 years. Do you possess any statistics regarding your trading performance, such as the percentage of winning trades you achieve or the average amounts of your stop losses? This information could be invaluable. Overall, consistently relying on this approach will significantly assist you in making more informed and better decisions in the market. So everyone, just a moment, Dimitri, wishing you all the best. Let's move on to the next essential tool in our analysis. Specifically, let's take a closer look at Bitcoin. So guys, on the daily time frame for Bitcoin, we can see the initial wave of impulse forming clearly, then the subsequent second wave of correction, followed by the strong third wave of impulse. This is represented as wave A, then wave B, and finally wave C, which signifies the correction phase. This overall pattern is crucial for understanding the market movements and potential future trends. Look how beautifully the market looks. Currently observe this specific level forming at the top and the corresponding level at the bottom. I suspect that this situation could potentially indicate a flat correction. If the price of Bitcoin can successfully overcome this significant mark in the near future, we might experience a downturn that leads to a deeper correction in the market. If Bitcoin demonstrates some significant growth in the near future, and we also receive confirmation from the 4-hour time frame, then we will actively seek out potential buying opportunities. In principle, purchases will primarily operate around here based on the breakout of this specific candle formation. Most likely this will be an upward movement I will try to buy. If we break the level mentioned below, everything will inevitably lead to a significant correction. We began selling Bitcoin just last week, I believe, and at this moment we are still holding on to our remaining assets. I currently have $1,700 in my account, but I assume that if there's a market reversal, I'll close the sales and begin buying again. Examine the 4-hour time frame for Bitcoin. We can see a recognizable pattern developing. 1, 2, 3, 4, and 5. Following this fifth wave, a correction typically occurs. Wave A, Wave B, and finally Wave C. Wave C has not yet reached the critical 50% level, nor has it approached the 38.2% mark. We have identified this specific descending price channel. As long as the price moves within this channel, the downward movement may continue. I repeat, while the price is in the channel, the correction continues. Once the price exits the established channel, a new wave begins to form. In this particular case, following the ABC pattern, it will signal the first and second waves of an upward trend. If we go down, we continue to work in the correction, allowing profits to grow. I will probably take profits at either 50% or 38.2% around these levels. For Bitcoin, I am currently still holding my sales position. However, if it breaks out of the established channel, I will definitely close my sales here with a profit, of course. I sold Bitcoin at this point and plan to start buying again, as there may potentially be another significant wave of growth ahead. The daily time frame chart looks quite interesting and intriguing, guys. It's remarkably beautiful, yes, clearly indicating 1, 2, 3 and an ABC pattern, followed by a 4 flat correction. This suggests potential movements in the market worth observing closely. You also, guys, read the Elliott Wave book. If you want me to send you the book, you can message me directly or on Instagram and I'll send it for free. A correction has been made. This is what a flat correction looks like, and usually after a flat correction ends, movement in the fifth wave can begin. But we also need to wait for confirmation that this will indeed be a rebound from this boundary. This will occur approximately within the 4-hour time frame channel that I previously demonstrated, where a breakout above the channel indicates a buying opportunity and any decline suggests a selling action. Here are the two main scenarios for Bitcoin. I'm still holding my sales position and allowing my profits to continue growing. So everyone, let's take a closer look at another useful tool in our toolkit. This is Ethereum. Colleagues, do you all recall this specific markup? I believe I posted it on my Instagram either on Sunday or Monday. Ethereum is undergoing its first, second, third, longest and fourth corrections. And then we still do not have the fifth wave that we are eagerly anticipating. I'm making this post and I'll show you right away on Sunday. Yes, I experienced this particular scenario so you can understand how it unfolds in the market and the dynamics involved. I had identified this trading channel and there was a significant breakout from the channel. I initially believed that this model represented the completion of an ABC correction, which led me to anticipate further growth. However, the market unexpectedly began to decline on Monday and entered a deeper correction phase. Therefore, it's crucial to note that your stop loss should have been positioned here, guys, to manage risk effectively. If you again fail to set stop loss orders and continue trading without them, you could end up losing your entire deposit in this situation. Just look at how short my stop was and how significantly the price fell. Without a stop, you could have easily lost 2 to 3 times more than what I did. Always use stops for protection. That's precisely why it is always extremely important to set stop loss orders when you trade based on my trading ideas. I share all my trading ideas in the exclusive closed channel, where I also set specific stops, and they are frequently short-term. I always try to enter trades favorably so that the ratio is 1 to 3 or 1 to 5, so that over time you can cover 3-5 stops with one trade, maybe even 8. Therefore, those who entered this place without taking a moment to pause likely lost a significant amount. Those who entered the market with a short stop loss strategy are doing quite well. They might patiently wait for another favorable entry point to trade Ethereum. In relation to the second entry point that I mentioned this week, I specifically shared that exact entry point for purchasing yesterday in my exclusive channel, ensuring that all members had access to this valuable information. Yesterday we decided to purchase Ethereum at this point, setting a stop loss here to minimize potential losses and establishing a take profit target here. This was an aggressive trading strategy involving a tight stop loss and a significant profit potential. In general, if something goes wrong, I will close at the stop and wait for the correction to finish. It might not happen on the first try, but it's better, guys, than trading without stops in the market. Without top positions, you are here temporarily again, and then you'll say that trading doesn't work at all. Right now, by the way, we have a breakout of the channel on Ethereum. I don't know yet if this is a false breakout or not, but there was a breakout and a consolidation. Correction may be underway now. Let's switch our analysis to the hourly time frame, because if we consider that this specific point marks the end of the fourth wave, then on the hourly time frame we should observe at least the formation of the first and second waves that indicate the beginning of the trend here. This observation is crucial for understanding the market dynamics according to a lower time frame perspective. Let's examine the hourly chart for Ethereum. On the hourly time frame, Ethereum can be analyzed and counted as this specific movement representing an impulse, starting with the first wave, followed by the second wave correction, indicating the initial and subsequent movements. After this, there emerged the third wave, and currently we are observing an ABC pattern, likely representing the fourth wave, which notably does not exceed the height of the first wave. Well, I assume that we should ideally proceed in this manner within the established framework of the fifth wave concept. This will be 1, 2, 3, 4, 5, and then most likely there will be an ABC correction, which is a common pattern seen in market movements. After that, we can expect another sequence of 1, 2, 3, 4, 5, followed again by an ABC correction. This means the market tends to move in a way that can be quite deceptive. Traders often exhibit a great deal of patience. They wait for the market to rise to its maximum point so rapidly that they can take advantage of quick earnings. However, this situation will undoubtedly test your psychology, especially when you invest in Ethereum and it creates structures that seem to work against you. The market may rise then drop sharply against you. Yet, when you truly understand the wave model, the uptrend resembles this sequence: first, second, third, fourth, and fifth. After the fifth wave, what follows is typically the ABC correction, where wave C frequently retraces to the minimum level of the fourth wave, often to shake out traders who entered the market during the previous upward movement. Those who bought here before the second wave, most likely it won't reach. Wave C rarely reaches. And then the cycle starts again. 1, 2, 3, 4, 5, followed by ABC, continuously knocking out these eager buyers. But usually beginners start to get lost here, to lose, to place stops behind the fourth, quickly move break-evens, and you are most often knocked out by this ABC. So when an ABC correction occurs, it indicates that buyers are being knocked out where they place their stops. So on Ethereum now I see such a rapid emergence of a trend that goes 1, 2, 3, 4, 5, then ABC will happen. Probably it will also take out stops here. We will execute our trading strategy based on the wave principle using the 4-hour time frame. For the time being, our stop will be positioned just behind the recent low to avoid being affected by any potential short-term fluctuations. We will patiently wait for approximately 2 to 3 weeks for the market to develop. In 2-3 weeks, the market will already form some interesting patterns. So let's proceed without delay and immediately examine what information we have here concerning the potential risks associated with the trade. The calculated risk per trade for us on Ethereum is set at $1,200, which indicates that I entered this position with approximately 1% of our total deposit. I'm poised to potentially earn an impressive 8 times that amount on this particular trade. So folks, do you sense the significant difference in our approach? Risk is 1%, profit is 8%, so if you have a distance of 10 trades with a ratio of 1 to 8, if at least 2 trades go positive, you'll already be making money. You'll be making money with at least 2 trades, but unfortunately, the market doesn't always provide such opportunities to make exactly such positions of 1 to 8. It happens rarely, but sometimes I find them. The more experience I have in trading, the better I can find them. So if I trade for another 5 to 10 years, I will probably soon be entering right here at the very lows at these shadows. It's really nice to enter here. Traders with 20 years of experience probably enter like this, set to break even. It goes up, then down to break even. Then they purchase again to reach break even, followed by a 10-fold increase, and then they aim for a 30-fold increase, please. But this requires 20 years of experience, most likely, to enter right on the shadows, on the candles, and to try so that each trade is 1 to 30. You will only need to make 2 trades even with 30 losses. By math, you will be making money, but again, for beginners, this will be too much of a psychological burden, so I am probably more of an average trader who enters after the price reversal. When we have reversed and gone a certain number of points, then I only start waking up and thinking about entering the market. But there are traders, guys, who enter right here. They already bought here and are sitting at break even. These are the most precise traders who can enter at good entry points. But this all must also be logical in terms of wave analysis, meaning it must definitely align with the waves, because waves are everything to us. Without wave analysis, how will you understand what kind of wave is coming, whether it's a correction or an impulse, how many points the price will move? I currently understand that I am taking the potential of this upward movement within the framework of the 5th wave. That is, I understand that I need to wait for the update of the 3rd wave to earn on the 5th. When you remove the waves, you will simply not understand where we are going, what movements await us. So in this regard, waves help a lot. So let's move on. There was a question about Tesla. Alright team, let's take a moment to analyze Tesla on the 4-hour time frame as well, so you can grasp how to effectively utilize both higher and lower time frames in order to trade in alignment with the prevailing trend indicated by the higher time frame. This approach will ultimately save you money, as it will reduce the number of stop losses incurred. When you focus solely on one time frame, statistically, you're likely to experience a greater frequency of stop losses, which can be quite costly. When you start trading on 2 time frames and trade the lower in the direction of the higher, the number of stop losses decreases significantly by about 50%. Next, we observe the formation of the first impulse wave here, which is primarily based on the detailed 4-hour chart. Following this, we encounter an ABCDE correction pattern within the context of the second wave. Subsequently, we witness a breakout of the triangle structure, marking the point where the first subwave begins its upward movement. So remember, when there is a breakout of the triangle formation after completing wave C, we can confidently begin counting that this is the initial subwave of the next movement. This entire downward movement we are observing is considered a correction, specifically the second subwave in the sequence. Next, I observe a descending channel pattern that will likely be broken soon, around levels 3, 4, and 5. We might go through such a structure. We need to patiently wait for the channel breakout. We can also incorporate the hourly time frame into our analysis and understand that from this point, we will identify and count the first and second waves based on the hourly time frame. This approach aligns with the overall trend indicated by the 4-hour time frame, ensuring a comprehensive view of market movements. Here we have the hourly time frame, and here is a clear impulse. This is all a correction. Then we patiently wait for the next price impulse, followed by a correction, and then observe the subsequent impulse. This entire sequence will be represented on the hourly time frame as waves 1, 2, 3, 4, and 5, with additional subwaves occurring on the 4-hour time frame. On the H1 chart, these will reflect larger, more significant global waves. Therefore, when you engage in trading from the higher time frame to the lower one, you should always do so in the direction of the higher time frame, ensuring that you are consistently trading with the prevailing market trend. If the higher time frame is not considered, many trades will be against the trend, resulting in many losses because you do not understand the overall logic of the higher time frame. Once you understand the logic of the higher time frame, you can trade on the lower one. That's why I'm holding off on buying Tesla, waiting for the second wave of correction to finish and to try to capitalize on the next third wave of growth. So, the next financial instrument we will discuss is the oil market. In the oil market, we currently have a profit totaling $800. We sold oil approximately 2 weeks ago. For those who remember, we had a sale here, we set a stop here, and we're working on the third wave on the daily time frame. So you have the first wave, the second wave correction, then Fibonacci at 50%, which is the average probability of a rebound, and then the continuation of the third wave. But also on the daily time frame, corrections can happen. So it's possible that right now the market is in the first wave on the daily time frame, and this is already the second wave. By the way, I want to remind you that I mentioned oil prices could enter a correction phase, as it's quite surprising that we've been experiencing a decline for 2 weeks without any significant correction. Correction not begun yet. Determine if the correction process has not begun. To create a Fibonacci ruler, you typically need to start drawing it from the end point of the initial wave. Now everyone, please hold on just a moment. I'm taking the Fibonacci ruler, drawing from the end of the first subwave, the beginning of the first subwave, and usually the correction. This second subwave should reach at least the 61.8 level. Only then can we confidently say that the correction has started, or even higher, like the 50% level. Then it will go 3, 4, 5. So right now, I assume that oil is in the stage of the second wave correction and may rise, but I don't see any sense in buying oil now, because this is a corrective movement that won't yield much profit. The task here is to effectively capture this impulse, yes, but through careful corrections, aiming to earn ratios of 1:3 or 1:5. If you try to buy during the correction now, it's still unclear how deep the correction will be, whether it will be shallow or deep. We might reach here and then immediately reverse and go down. That's why I don't recommend trading corrections at all. It's generally more advantageous to trade impulse waves because with impulses it becomes clear where the overall market direction is heading and how to easily count the individual subwaves, and at least 5, while the correction is only 3 waves. And they are typically quite brief in duration or length. Next is the 4-hour time frame. On the 4-hour time frame, we can clearly observe that this entire downward movement represents the initial impulse wave of the trend. Next, we have a breakout of the triangle, and this marks the beginning of the second correction wave. What the second correction wave will be like is also in question, either around 618 or around 50%. So we'll have to wait, guys. We'll need to be patient, wait for the formation of the second wave, then we can make profits on the third. In the market, I typically advise against trading during the first and second waves. To illustrate this point, here's a current live example. I entered my position during the first wave, and now the second wave could either result in a loss for me or allow me to break even. Only after this phase concludes will the third wave begin to develop and provide potential opportunities. Therefore, it's categorically better not to trade the first and second waves. It's generally more advantageous to engage in trading after the second wave has formed in the third. This timing allows traders to quickly generate profits and exit the market effectively. We found ourselves entering a trade slightly earlier than optimal, just before hitting the take profit point, which subsequently led us into a corrective phase. Consequently, for the time being, we are maintaining our sales positions on oil. Our options include either closing those positions at break-even or potentially adjusting the stop loss to this maximum level or even accepting a minor loss if necessary. We'll closely monitor the situation as it develops. I believe that oil still requires additional time, likely another week or two, to fully complete the necessary correction. After that, we can anticipate the next price impulse where we should begin to see profits. It will become intriguing there. The most interesting things happen in the third wave, guys, not in the first and second waves. So let's move on. Next market, guys. Let's take a look at the currency market. We'll briefly go over the first instrument, which is the euro dollar. So for the euro dollar, we have a daily time frame. In this analysis, we observed the formation of 5 distinct waves moving upwards, followed by an ABC correction that retraced downwards. After this, we are now witnessing the development of ABC2, which is viewed as the initial phase of a new and emerging trend. If the euro breaks through the channel now, I would definitely consider joining the buy positions. Yes, here at the channel, breakout buying would be interesting within the third wave. If the euro breaks through this ascending channel, which has been established, there might be a deeper correction in its value. Additionally, we also observe 3 significant bounces occurring at this level, indicating potential shifts in market momentum and investor sentiment. 3 bounces that are still unclear. Here's a detailed overview of the first, second, and third bounce we've observed. So we need clear confirmation of the breakout from this established channel in order to strategically sell on the bounce from the upper boundary of this channel. So there's that logic. And if we decide to move upward now with a breakout, this specific level could potentially work out quite well for us. If there's a breakout, there will be a good upward movement, and we can also try to earn on that. Next, let's take a closer look at the 4-hour time frame, colleagues. Here, on this 4-hour chart, we can observe a triangle pattern forming, which represents a corrective figure in the market. This indicates that the price action may be consolidating before making a significant move. Additionally, it is possible that the market could be exhibiting 2 distinct structures, suggesting that traders should remain vigilant and consider the implications of these formations for future price movements and potential trading opportunities. The first scenario involves a bounce off the channel boundary followed by a breakout downward. The second scenario, which I personally prefer and find more appealing, is that we had a sequence of numbers 1, 2, 3, 4, and 5, which will collectively be considered our very first wave number 1. Here is the first wave number 1, which is followed by correction number 2. After that, we will encounter the next significant wave, which will be the breakout of the triangle pattern, leading us to wave number 3. This is my second scenario for the breakout of the triangle. Today, I also provided an entry point in the market where we are waiting for the breakout of the triangle, and we can either buy here for a move up or sell for a move down. I have one primary scenario and an alternative scenario. If the situation doesn't go in our favor and trends upwards, we will sell the euro. Naturally, ascending seems to be the most logical choice. I will elaborate on why this approach fosters growth effectively. Yes, because right now, look here, the second wave of correction is finishing. Logically, we should have this entire model 1, 2, and the next waves should be 3, 4, 5, meaning this logic is in the direction of the trend on the daily time frame. If we switch to the 4-hour time frame, we can see that this upward movement starts from here. This is all correction 2, and there will be very good buying opportunities at 3. Guys, don't miss it. If there's a breakout upwards, my buy stop will trigger, and I can work with a short stop and an entry point to capitalize on this upward movement. Again, 1 to 5, maybe 1 to 7. So don't get confused. Wait for breakouts and confirmations to validate your scenarios. So moving on, guys, the next instrument is dollar-yen. For the dollar-yen currency pair, the sale is currently in progress, indicating that the trade has been officially open for selling. Overall, the market context can be categorized as first, second, third, and fourth stages. The fourth wave is indeed smaller in magnitude compared to the significantly larger third wave, right? This means that the market impulse is significantly greater than the subsequent correction. Therefore, if we consolidate below the channel, there may be a notable decline within the fifth wave, which will appear as follows. If there happens to be a bounce from the channel, it could continue its upward trajectory and the ongoing correction might come to an end soon. As long as the correction is less than the impulse, we continue selling. Once the correction becomes larger than the impulse, we will start working on buying. And we will consider this upward movement from the perspective of an upward trend. So for now, I have open sales. On the 4-hour time frame, we also formed the first wave, second correction, then the formation of a triangle, and we need to wait for either a breakout of the triangle upwards to buy or a breakout downwards to sell. However, since I opened sales just 2 days ago, I am choosing to hold on to the sales for now. And if it goes up, I'll close with a small loss and will buy. For the time being, these are the two main alternative scenarios regarding the future of the dollar and yen. On the hourly time frame, guys, I shared this trading position with you on Instagram. I'm sure everyone remembers it well. There was an impulse, then a zigzag correction ABC. Next, this downward movement I assume represents an extension within the first wave, indicating that we are observing the first, second, third, fourth and fifth waves in this particular sequence. All of this was indeed an extension during the first wave. Reason for first wave extension? The reason is that the third wave did not reach or update the minimum value established during the first wave. So all of this represents subwaves. Next, I assume that this is indeed the anticipated second wave of correction. Additionally, I'm analyzing this channel and I believe that upon the breakout of this channel, everything could align with the anticipated scenario, indicating that this movement is all part of an impulse followed by a correction phase. Therefore, I'm carefully holding on to my sales position and closely monitoring the triangle pattern on the 4-hour time frame. Next, guys, the next instrument I want to highlight is the ideal currency pair that has consistently shown good profit potential over the past 2 to 3 weeks, the US dollar against the Canadian dollar. For the dollar to Canadian dollar exchange rate, on the higher time frame analysis, we observed the formation of one strong impulse wave, followed by 2 corrective phases, then a 3-wave impulse, another 4 corrective phase, and finally the completion of the trend with the 5-wave. After this, we have the correction wave A, wave B, wave C. Here we observe the continuation of the upward movement once again, suggesting that this could potentially still be part of wave A, or perhaps it's actually wave B with wave C to follow afterwards. Regardless of the specifics, this entire ABC correction model is expected to align with the 61.8 or 50% retracement level, and we are actively focusing on making purchases. Profit from the purchase has reached $1,300. On the 4-hour time frame chart, we are currently forming the initial impulse wave, followed by the second corrective wave, then the subsequent third impulse wave, and finally the fourth corrective wave, indicating market fluctuations. And just a quick reminder, everyone, about a week ago I mentioned that I had also demonstrated during my streams my purchase of the Canadian dollar right here. My designated stop is already set right here, exactly. I moved it. Now we are observing the fifth wave actively engaging in the ABC correction on the daily time frame, indicating potential growth ahead. Look how beautifully the market is developing from the perspective of wave analysis. Allow me to illustrate how long this particular trade has been successfully operating so you can fully grasp the concept of medium-term trading. Here we have wave 4, which is on 08-10-07. And now, over the past nearly 2 weeks since the 21st of the month, we have experienced consistent growth. This situation represents a fairly straightforward trading scenario where you made a purchase, and as a result, the market has been steadily rising for a duration of 2 weeks. I'll wait another week to see if we hit the take profit. Yes, overall, the picture clearly shows a strong upward trend, and the total risk involved in this trade was $657, while my profit amounted to a significant $3,000. The trade provides me with an impressive 1-to-5 risk-reward ratio. 1-to-5, and I will continue to move the stop, and we might soon even reach break-even. That's why this strategy focuses on medium-term trading, where you carefully enter the market and patiently wait for 2 weeks, resulting in earning $1,300. Many traders come to the market wanting to earn every day, wanting to earn every week. But if you're trading medium-term, it doesn't work that way, because sometimes you have a week like the one we're seeing now with gold. Let's take a look at gold. What did we see this week? We had an exciting opening on Monday, observed a noticeable drop followed by a rise and then yet another drop. So essentially that's how the entire week unfolded for us. The market consistently moved in this specific structure throughout the entire week. Now I have a question for you. What specific amount do you want to earn here? In such challenging markets, you likely won't make any money. Money can be made in this market when there's a strong upward movement, followed by a significant downward movement, and then another rise again. This consolidation, this correction doesn't make money either. You don't make any money here either. Money is generated in quick impulses, particularly during strong market movements. And here everyone is where the newcomers are tested on just how much money they will ultimately lose. Here most likely money is being lost. Newbies are losing their deposits. Those short traders with $50 to $100 are also entering with all their volume, waiting for the next strong movement. But until we liquidate everyone here, the movement won't start. So it's better for us to take a medium-term position, enter the market, set a stop here, and wait until we liquidate everyone. Let everyone temporarily lose their capital for the time being, and in the end, when no one is remaining, we will reveal the next significant growth in the third wave. So, during these uncertain periods, guys, you need to consider switching to medium-term trading strategies. Short-term trading will ruin your psychology. To achieve lasting success, you won't be able to earn significant profits in the long run with just a short-term strategy alone. I haven't met such traders. Usually people make money in the long term, waiting 3 months or half a year, or in medium term. Or short term, which is a week. A single trade will typically be in play for approximately 1 week. In order to successfully navigate through such challenging periods, you need to develop resilience. Naturally, the market will put newcomers' psychological strength to the test, examining how they will respond and act in these difficult situations. Some will lose their accounts while others will profit. The most patient traders are those who understand how to effectively trade according to a well-defined trading plan. So everyone, let's take a moment to summarize the trading week we just experienced. The euro-dollar in the currency market is our focus. If there is a breakout of the triangle upwards, I will buy. If there is a breakout downwards, I will sell. So there are basically two scenarios. Today I shared in a closed channel, we're working and waiting for a triangle breakout. Next, the dollar-yen is also a triangle. Breakout up means buy, breakout down means sell. For now, I'm holding sales towards the hourly time frame. Following this scenario, first, second, 1, 2 extension in the first wave, breakout 3 down, decline. Next, the dollar-Canadian currency pair is performing exceptionally well. We've reached a commendable profit of $1,300, steadily increasing as time goes on. It's better to grow slowly and steadily than to rush and risk losing our deposit. We are currently awaiting the fifth wave target for the dollar-Canadian, already enjoying a profit of $1,300. Gold enthusiasts, this week I'm temporarily holding off on gold purchases until the end of the week. My stop loss is set at this level and my take profit is established here. I'm actively working within this particular deal. It proves to be highly profitable for me, allowing for a short stop and substantial profit margins. I truly need to pursue and secure more such deals. Moving on to Bitcoin now. For Bitcoin, I currently have open sales, but if there's a breakout of the channel here, I'll buy on a flat correction on the daily time frame. Waves present a complicated situation. Yeah, guys, what did you expect? Did you think trading is really easy? Many individuals come with the belief that they will easily earn money through trading, thinking it is as simple as just clicking buy or sell, and that all they need is a laptop to get started. Certainly. Here's the expanded version of your text. No, you've embarked on a challenging business journey where it will be quite difficult to generate substantial profits. As you begin to delve into the intricate details of wave analysis and the complexities of trading psychology, you may find yourself questioning whether this line of trading is truly meant for you or not. Because honestly, I'm tired of seeing on Instagram that everyone shows how easy it is to make money trading, that I bought a car, come to me, and I'll teach you. Well, it definitely won't be like that here, trust me. Here's oil, guys, oil sales. But there might be a correction through the second wave. We have a correction going on. Profit at $800. The final tool we have in our arsenal is Tesla, and at this moment we are patiently waiting for ideal purchasing opportunities. As for Ethereum, we are also planning to buy again soon. I believe that the fifth wave of growth may still be on the horizon. This suggests that what we are witnessing now is merely a deep correction, and further growth for Ethereum is still entirely possible. We are actively monitoring Bitcoin's performance. If Ethereum experiences an increase, it is very likely that Bitcoin will also rise in value. I believe you already know the best places to make your purchase, as I discussed this in detail regarding Ethereum earlier today. Hey everyone, today we're excited to offer a fantastic 30% discount on our annual subscription plan. If you're interested in joining the exclusive closed channel where I share my detailed wave analysis, I typically provide insights into how my wave analysis is constructed, including specific stop points, entry points, and recommended take profit levels. Then you proceed to work on purchasing Ethereum by using this particular image as a reference, for instance. I always provide clear stop points, specific targets, and precise entry points for you, so you can easily copy these positions without needing to come up with any strategies on your own. Right now, there is a 30% discount on the annual plan. You can also easily extend your subscription by paying the difference of 30% and seamlessly switch to the more beneficial annual plan. If anyone is interested, if you want to start trading properly while managing risks based on the wave principle, meaning stop losing money, you can join my closed channel by messaging me directly or on Telegram, and I will add you to our community where there are already over 500 people and everyone is satisfied. They are all trading. Many are starting to see changes in their lives because they are finally making money from trading. Those individuals who truly understand how wave analysis functions, particularly those who have been actively trading for a year or two, I believe they already possess the knowledge to effectively utilize this technique. Newbies will need to work a bit on their psychology as well, because if you trade based on my analysis, I don't know what psychological issues you might face, such as excitement or taking on too much risk. All of this affects your trading. Therefore, it is better to go through training comprehensively and get a subscription so that you can be prepared both technically and psychologically, and then trade based on the subscription. Absolutely, this is a comprehensive package designed to significantly increase your chances of achieving success.